screen. With this, let me turn it over to Ed.
Thanks, Odie.
You're welcome.
Good job. He's a little bit better than me, so bear with me, please. Um, what I really wanted to go over is why people trade swaps, why our customers trade swaps, and different types of trades. Just very basic to give you an overview. So, why trade a swap? Uh, First reason is that somebody just wants to take a position in the market. It could be, like Odie said, a commodity swap, an interest rate swap. Suppose you think interest rates are going up, and you want to take a position based on that to, for whatever reason it may be, to make money. Maybe you're a speculator, a hedge fund, a proprietary trader. Could be any customer. You have a view that rates are going to move. You want to lock in where rates are now, or you want to believe that if rates go higher, you want to take advantage of them being higher at a later period. Um, why people would do those trades? There's three major types of ways that I would group trades. One would be relative value, or RV, you would hear, where somebody would think, okay, maybe 2 year rates are low now, but I think they may be higher in 10 years. And based on that, the 5 year point in between doesn't really make sense. So you might try and do a butterfly trade where you take advantage of that, of your view versus where the market's pricing presently. So that would be an example of maybe a relative value trade. We'll go more into the mechanics of butterflies and other type trades later. Another reason would be a technical trader. A technical trader is a guy that looks at charts, and you see this stocks on CNBC all the time. Mom's Money Club is out there looking at some stock chart. Looks like it's been going up for 10 days in a row. Let's buy this. It's going to go higher. We'll make some money. Hopefully that works. The other major reason why we would do a trade would be a macro view. A macro view is somebody who's taking a look at the world, and they think that what the markets are pricing presently doesn't really reflect the bigger geopolitical things going on in the world. Right now, all of us go to the supermarket. We buy some milk. We got to buy some bread. We have to buy some peanut butter for the bread. We notice that everything is like double in price. Like inflation's going crazy. Based on that, we think the Fed should probably hike rates. So we put on a rate that we think interest rates, or we put on a trade that interest rates are going to go higher. Ben Bernanke comes out, says it's transitory, and you lose money on that trade. So those are the three major reasons. The types of trades you would do, you would trade, like I said, kind of if the market's going to go up or down. If you think that one particular part of the market is rich or cheap. Um, and then there's also a whole other segment where you can actually trade options on those views, where we're not going to get into that today. All right. Um, Next thing on the slide here, and I want to use this toy because it's pretty cool. Retail bank. A lot of business we do is with TD Bank NA, which is our retail bank. Basically, what they do is they'll go out and lend their customers fixed rate loans. They need a more effective way to manage that. They'll come to the interest rate swap desk and want to swap that into a floating rate. Because if you reduce that longer term fixed rate into 3 month intervals or shorter, it's less volatility on your earnings and you can manage it better. Commodity producer, once again, somebody say a oil company. Their oil's going through the roof right now. They're making tons and tons of money. Who knows what's going to happen next year? Oil could crash if the economy crashes. So what they'll do is they'll fix in the price of oil right now, try and create a steady income stream in the future, and that way they can kind of manage their cost expense as well, where they know that their income will be more steady. They know what their costs are. It's a much more efficient way to manage your business, less volatility, less unpredictability in terms of can you pay your employees, are you going to make tons of money next quarter? You want to smooth that out, keep the shareholders happy. Benefits of a swap: the mitigate price risk is kind of what I said. The other benefit here in terms of if you manage your bottom line net income by using a swap, you avoid the big fluctuations in earnings. Whereby, if that's the case, tax rates in the U.S. go up the more you make, the more money you make, the higher tax rate the higher the tax rate is. So what you want to do is try and smooth that out if you can to avoid paying maybe 40% one year, and the next year if you don't make any money on the same amount of income, you'll be paying zero. But if you smooth it out, you have only a tax rate of say 20% over 2 years on the same amount of total income. Okay, why do some of our clients want to do swaps? One major segment of the clientele is mortgage servicers. And this is a revenue hedging thing, which is one of the tougher concepts, but I'll just briefly kind of touch on it. Basically, a mortgage servicer makes their money when they buy an asset which produces